What if I told you that the secret to the trillion-dollar options market, the literal holy grail of Wall Street, was actually discovered by watching how a cup of coffee cools down? Welcome to today's deep dive.
It's pretty wild.
Right. We're looking at a stack of research papers, financial history articles, and quantitative notes, all centered on one thing, the Black-Scholes formula.
Yeah, the equation that basically changed everything.
Exactly. So the mission for you listening today is simple. We are going to demystify this complex math and see how it turned options trading from a blind guessing game into a precise science. Okay, let's unpack this. Because before 1973, trading options was just the Wild West.
Oh, absolutely. You had guys yelling out prices based on gut feeling, rules of thumb, and frankly, just, well, luck.
Yeah, there was zero standard for pricing risk, right?
None.
Yeah.
I mean, imagine trying to buy car insurance, but the agent just looks at you and guesses a premium based on their mood. That was Wall Street.
So how do we get from that to a Nobel Prize?
By looking outside of finance entirely. Fisher Black, Scholes, and Robert Merton, they looked at physics, specifically the heat equation.
Wait, like how heat diffuses through a solid material.
Exactly. And adapting that equation to price financial options was just such a massive breakthrough that Scholes and Merton actually won the 1997 Nobel Prize in economics for it.
Wait, I need to pause here. How is heat leaving my coffee mathematically the same as a stock's price moving? I mean, heat moving is just atoms bumping into each other randomly, right?
Yeah, exactly. And that random bumping is called Brownian motion in physics. It's how particles disperse. And in finance, it perfectly mirrors the random walk of a stock price.
So the equation treats the uncertainty of a stock's future price exactly like particles diffusing over time.
You got it. It calculates an option's fair price by balancing time to expiration, the current asset price, volatility, and risk-free interest rates.
So it's pricing the uncertainty of that random walk. And if I'm reading these notes right, the core engine of this math is the no arbitrage principle. Arbitrage is basically a risk-free profit. So this principle just assumes that free money shouldn't exist in a fair market.
Spot on. The math constructs a hypothetical perfectly hedged portfolio, meaning you hold the option and the underlying stock in exact proportions.
So if the stock goes up, your option covers it, and vice versa.
Right. Because there is zero directional risk, your return absolutely must exactly equal a standard risk-free bank deposit.
Because if it paid out more, you'd have an infinite money glitch.
Exactly. The formula finds the precise price that closes that glitch.
But here's the thing. Calculating that fair price is great on paper, but the market never stops moving. The stock price ticks up, time ticks down.
Yeah, so to actually keep that portfolio perfectly hedged, traders have to constantly adjust to a moving target.
Which brings us to the Greeks.
Right. These are derivatives extracted from the main formula to measure specific risks on the fly. You have delta, gamma, theta, and vega.
I like to picture the option as a moving car. Delta is our speed, like how much the option price moves when the stock moves.
Yeah, and gamma is your acceleration, how fast our delta is changing.
And theta is like a hole in the gas tank, just a fuel gauge constantly emptying out as we lose time approaching expiration.
That is a brilliant way to visualize how they actually use the math to manage risk. If a trader sees their speed getting too high, they know exactly how to adjust their portfolio to slow it down. Though I do have to point out, vega isn't actually a Greek letter.
Wait, seriously?
Yes. I mean, traders use vega to measure how an options price reacts to a 1% jump in market volatility, but linguistically. Totally made up.
No way. The highest levels of finance rely on a fake Greek letter.
They really do.
I love that. But here's where it gets really interesting. You've got this beautiful Nobel Prize-winning math giving us perfect metrics for speed, acceleration, and fuel.
Right.
But what happens when the road itself suddenly falls away? Because this model has some pretty fatal real-world flaws.
It does, mostly because of its mathematical assumptions.
Oh.
Black-Scholes assumes volatility is perfectly constant,
Okay.
and that markets follow a normal, log-normal distribution, meaning prices move in predictable, smooth curves.
Smooth curves. Right, so the formula assumes we are always driving on a neatly paved road, but a market crash is like the road suddenly turning into a sheer cliff.
Exactly. In statistics, those cliffs are called fat tails. Extreme events that the math says are basically impossible.
But look at reality. Traders know cliffs exist, which is why we see the volatility smile.
Yes, they will intentionally overpay for out-of-the-money options. They're basically buying disaster insurance for crashes that the Black-Scholes formula says shouldn't happen.
Right. And if you look at crypto markets, falling off a cliff is just a regular Tuesday.
So true.
So for you listening, the big takeaway from all this research is that when you buy an option, you aren't just betting on price direction. You are trading volatility. You are trading time.
Yeah, and if we connect this to the bigger picture, despite the fat tails and the fake Greek letters, Black-Scholes remains the universal language of finance.
Trillions of dollars of risk are priced using its framework every single day.
Exactly. It's an imperfect map, but it's the map everyone agrees to use.
An imperfect map built for 1973. Which leaves me with this final thought. The model's math only works perfectly if you assume continuous trading with absolutely zero transaction fees.
Which was physically impossible for humans back then.
Right. But what about tomorrow? If AI-driven, zero-fee microtrading becomes the absolute standard, will the Black-Scholes model finally become perfectly accurate, or will machines just break the formula entirely?